Now look at this price action right in here. We had the run here. The next candle, we trade all the way back down, completely close it in. So we filled in all of this BISI, immediate. So it was an immediate rebalance. No fair value gap, no liquidity void that was left that had to come back to at a later time. This was an immediate rebalance. Put that in your notes because we will be talking about that this weekend. So we had an immediate rebalance, and then price rallied back up through it again. So look at what we have here. We have a 5-minute candle going up, a 5-minute candle going down, and a 5-minute candle going back up. This whole business in here, okay, is a balanced price range. So when price was trading back down on this down candle, and in the next candle here, I wanted to get in when it was going down. I felt confident that we weren't going to go back inside this range, not even to a mean threshold of this range. Wouldn't be necessary because it's balanced. And we had relative equal highs. So we had buy side liquidity resting above this high here. And if you wouldn't have taken that trade, you have your standard mean threshold of bullish order block right here. Price trades down to it here. Add the spread. You can go long on that. Also, you have a optimal trade entry. Okay, trades down into sweet spot and almost to the 79% level to the pip, and add the spread, and that would be your objective for going long there also. So there's 3 different conditions that you could trade on in this general area. We have the mitigation block. Okay, now what makes this the mitigation block? We had a stop run down here, so price rally through this high. So if we had this low being lower than this low here, much more significantly lower, then this would be deemed as a bullish breaker. But because it doesn't really form the breaker here, it is a mitigation block. So anything that were placed on short here, they have to mitigate that and take it off before price rallies. Okay, so it holds price in here, allowing mitigation. And when you have that, and you have the understanding, you grow very comfortable when price is in consolidation and holding before the price runs. It's not fun to hold into it, but it allows you the confidence to still stick with it. Because it spends a little bit of time in here and then came back, allowing mitigation again, and then takes off. And then the closer look on the 15-minute time frame for euro dollar. These are all the fair value gaps and bearish order block confluences. Rebalance back into here. And then this is the one I want to talk about. That's the only thing besides that and this that's noteworthy on the 15-minute time frame is we had a relative equal highs. Again, this is a 15-minute time frame. So we had buy stops resting above that. The market surges, runs those buy stops out, and then slants back lower. So we've taken out the low between the high and the higher high to the right. So this sets the stage for a bearish breaker. If this high would have been lower than this one, and we broke lower, then this would have been a mitigation block. Okay, that's the distinction. I got a question over the holidays, and I have a note in front of me. Could I please make it again a distinction between what is a mitigation block and what is a breaker? A breaker is a run on the stops in line with order flow. A mitigation block is a high with a low between it and a lower high than the previous high. So in other words, it's a reverse of this scenario here. It would be reversed. This high would be higher than this one. So it's not running of stops. It's just they sent it higher. Usually that occurs with a fair value gap or return back to the mean threshold of a bearish order block. And then it rolls over lower. And once it breaks the low in between, if it trades back to that, then it's a mitigation block. I will trade mitigation with adding to an existing trade. I do not like to use mitigation blocks as the inception of a new trade position. And the reason why I don't like to do that is because I prefer and I side on the breaker as a stronger pattern. Mitigation is a little bit uncertain, and I share in that opinion because I don't have enough love for the pattern to enter a new trade at a mitigation block. So I will all the time consider entering a new position at a breaker because you're getting at the beginning of the next strongest part of the move. So this particular down close candle here,
That's what I'm highlighting with that little arrow here. That is the actual bearish ICT breaker. The market trades back up into it here. We leave it and then touch it one more time at the bottom. This is our London open. We have a measured move, the high to the low, and it projects down here. It overshot it about 3 or 4 pips, but just do the measurements on here, and you'll see we get that same measurement here. Really nice in terms of symmetry.